So we'll kick it off and are going to be actually covering a topic tonight based on a suggestion from a member from last week. So excited to do that. We'll go through the disclaimer real quick. Altos Trading and anyone who uses the trade trend resilient software knows that it's intended to be used as an information service for subscribers, and it doesn't incorporate opinions as to buying, selling, and holding various stocks and other securities. However, the owners of Altos Trading and the trade trend resilient software are not brokers, so we don't provide investment advice to any particular investor under any particular circumstances. And so we don't, for that reason, don't accept responsibility for any decisions made by subscribers using our software or any of our educational services. And any subscribers to the trade trend resilient software or any other persons who attend our educational events or buy, sell, and hold securities based on that information should do so with caution and consult with a broker or investment advisor before doing so. All right, so again, welcome everybody. Thanks for being here, and great to have our Zillion members on who got to see the latest updates to the Zillion platform as well. We'll be using the Zillion platform to do our market overview tonight, map out our levels, and a lot of interesting things happening in the market right now. Obviously, we started a major Fed meeting today. So the Federal Open Markets Committee is meeting today and tomorrow, and the interest rate announcement comes tomorrow. So that's why there was a lot of volatility in the market today, as well as a market sell-off. And we're going to talk a little bit about that and how it impacts things this week, mainly around the fact that the rate hike, whatever it ends up being tomorrow, and the consensus is it's going to be a 0.75 point rate hike, is already built or priced into current markets. So really any movement we see is going to be around other more intangible variables like comments from the Fed Reserve Chairman, sentiment, and things like that. We'll follow up on our 36-month moving average and Bollinger Bands. And we're going to talk, again, based on a recommendation from a member on our last week's session about short straddles and selling premium in these types of markets environments. And a very timely topic because volatility is elevated, and we want to sell option premium when volatility is at higher levels. We don't want to, this is really a bad time to be buying options. In particular, strategies like buying a call or a put that are have a lot of theta exposure. So they're vulnerable to decay because we're already at a high level of volatility. And there are long option strategies that incorporate short options like vertical spreads that can help counteract that. And we've gone over some of those in the past, and we'll continue to do so. But for this week, selling premium is a timely and appropriate topic and strategy. So we're going to cover that. And then if we have time, we'll do ticker roundtable. All right, so let's go ahead and get into our platform and map out the levels on the major indices. And we'll look at the VIX as well, and talk a little bit about what happened today. So again, as I mentioned, the expectation is the Fed is going to hike rates tomorrow by 0.75 basis points. The reason being is the August CPI came in hotter than expected. There was an increase in inflation, and that was around the time that the Fed held the Jackson Hole Symposium, where Jerome Powell gave a lot of hawkish comments that caused this downturn that we saw in the second half of August. We got a bit of a rebound, but it's really a dead cat bounce or a bear market rebound, as people refer to it, followed by a continuation of the sell-off. And I think last week we talked about the significance of the roughly 3,900 to 3,925 support level on the S&P. So that was broken on the 13th. Sorry, actually the low 39.21. It was kind of right there on the 13th. breached actually on the 14th. And so I've actually taken some short positions as hedges against long positions that I bought way back in July and August, because of this, the breach of this major support level on the S&P and the rise in the VIX. And so we'll talk about that too. But the significance for today and this weekend going into the Fed meeting tomorrow is where the S&P resides, which is at 3855.93 and below that major support level. So we broke it, and what we, in our analysis last Tuesday, what we commented on was if we break that 3900 support level, we're likely to see a continuation of a down move in the lower levels of support. And so that happened today. We hit a low of 3827 and change, but ended up closing above what really is the support level, 3850. So that's the first one we're going to map here as a support for tomorrow, because we're almost right at that level, and it's going to be relevant for tomorrow's trading. So just right here at about 3850. Okay, so that's a half century mark, and one to pay close attention to tomorrow, because we're currently closed above that level, and have seen significant support and resistance near that zone in the past. And even over the last several trading days, we're finding support. So there's not enough selling pressure yet to put us below that. And that's where the relevance of the rate hike that's expected for tomorrow comes into play, because that's, again, likely and almost certainly built into market pricing at this point. So that doesn't mean there's not going to be more volatility or a strong directional move up or down, but what's going to cause that is not the actual rate hike. Most likely it's going to be comments from Jerome Powell. So if again, expectation is a 0.75 rate hike, and if that happens, people are really going to be looking for, because again, that's built into the market pricing, are looking for the tone of his statements, hawkish or dovish. And based on the CPI report from August and the aggressiveness of the rate hike, he's probably going to be more hawkish, right? He's going to, it's always unpredictable. We don't know, and that's where the volatility is going to come in. But it's leaning towards more of a hawkish, tone. So it's probably going to be more negative than positive, but you never know. They could try to spin it the other way. And market participants are going to be, listening to that and following it very closely. So that's really what's going to drive the markets tomorrow and probably through the remainder of the week as far as catalysts. And I think as long as we watch these key levels and how price reacts around them, because we can't predict the future as far as what he's going to say tomorrow, or even exactly what the rate hike is going to be, although it's very likely to be a 0.75. We want to watch the levels, because that's really going to give us the best indication of what might happen after this Fed meeting. So the support zone is key here, 3,800 to 3,850, century to half century mark. And so if the market reacts in a way that we hold this support zone and are able to close, and tomorrow's close is going to be very key and significant, because not insignificant, key and significant, because it follows the announcement of the rate hike and the Fed comments. So if we close above 3850 tomorrow, we're going to be more likely to see an up move in the market. If the market reacts negatively, we could come down and find 3,800 as a support. If we see a close tomorrow below 3,800, then that is now a new, a very significant resistance level. And remember, this impacts the broader market. So we're looking at the S&P currently, but this is going to have a broad market impact. So on individual equities, even outside of the S&P 500 index. And so if we close below 3,800 tomorrow, which is, I think, less likely, it's again, the fear around the rate hike is already priced in. And it's really going to take a lot of hawkish sentiment to continue the sell-off that we've been in the last week or so. But if we close below 3,800, then we expect to see retests of lows from June and July. So like 3750, 3650. All right, so that's kind of how to navigate what comes out of tomorrow's meeting. And so what I try to like lean out of all this is kind of that buy the rumor, sell the news type of thing is, although we don't necessarily go that direction, it's more the contrarian approach. Remember, people are largely going to be reacting to something that's already priced in. So you don't want to get caught in the trap of, the 0.75 rate hike is already priced in. Maybe there's, hawkish comments from Fed chairman, and then it causes increased volatility, but ultimately subsides and markets recover. So, you don't want to get caught in that type of trap. So it's better to wait, until we have more clarity around how the major indices are going to react around these levels. So those are the ones really to watch, particularly for tomorrow, 3,800. So right now we've got support at 3,850 and 3,800. And then because there is a possibility we close below 3,800 tomorrow, then we want to, react accordingly there, because that's going to pump more bearish sentiment into the market. And let's actually look real quick before we go over to the NASDAQ at our probabilities here. So let's look at the SPX out to the Friday expiration. So that's going to be what, the 23rd? So right, we're 20th. Yeah, 23rd. So options market does a great job at pricing in expected moves, volatility, etc. So we have an expected move up or down of 104 points on the S&P 500 index, the SPX. So that's right here. Right, so either direction, plus or minus. We've mapped our support levels to watch for tomorrow and through the rest of the week. So 3,800 is, well, let's look at 3,850 first. All right, so options market is pricing in about a flip of the coin chance of closing above or below 3,850 by Friday. 3,800 has, the odds are in our favor. We're going to close. That level is going to hold because we mapped it as a support level, and specifically as a zone between 3,800 and 3,850 is going to hold. So the odds are in our favor that 3,800 will hold, because there's a 66.5% chance that the S&P 500 index will close above 3,800 by Friday. And we can actually even look for tomorrow. That's kind of the beauty of the expiration cycles that are available on the SPX, and see what the option probabilities are telling us. So 3,850, remember, that's our first support level to watch. We're only 5 points above it, almost 6 points. Actually has greater than a 52% chance. So the odds are telling us that there's a slightly better chance we're going to hold that level and stay above it by close tomorrow. But we have a very high chance of touching it, 94% chance. So that's why we want to really watch that level for support, and then 3,800. It's going to be quite unlikely that we're going to close below tomorrow. So that tells us that reinforces what I've just mentioned, that this rate hike is mostly priced into the market, if not entirely. So we have a 75% chance of closing above 3,800 tomorrow. And just a flip of the coin chance of actually touching that level, before the close tomorrow. So these are good probabilities to know. And one thing I want to mention too about major events, and you can kind of build this into your psychology and the way that you approach the markets. And again, it goes back to that, buy the rumor, sell the news. When there's a known event like a rate hike, a quarterly earnings release for an individual company, an FDA announcement, something that we know is coming up, it is almost always priced into the market by the time the event arrives. So that's crucial information to know, because and the reason being, what most people end up doing is they react to the information, and then the market flips on you. So think of all the times that you made a trade or an investment, and based on something like that, and it moved against you right away. That's likely the reason, because whatever whatever catalyst you were, or information based on a catalyst you were using to make a trading decision was already priced in. So a lot of times if something reverses on you quickly like that, it's because it was priced into the market. What is not priced into the markets are unknowns. And those are, so we have to handle those in different ways. But those would be like black swan events. 9/11 would be a very good and obvious example. On September 10th, nobody knew that 9/11 was going to happen. And then it did. So that's an unknown catalyst. So those are obviously not priced into the market. And so the reason I make that distinction is you want to really consider what's probably already priced into the market, so that you don't get, tricked or trapped into something that's already happened. So like right now, the market's been selling off after we hit this rebound on September 12th and then rotated lower. This is all because of the Fed meeting, right? And the fear behind rising inflation and rate hikes. So we haven't even had the rate hike yet. It comes tomorrow. So this is already the expectation of what's going to happen tomorrow. So again, just don't get trapped into thinking that, there's going to be a big rate hike. A 0.75 rate hike is a aggressive rate hike. And so when that gets announced, don't think, oh, the market's going to sell off dramatically, because it's already been priced in. So again, what's going to cause the volatility and directional movement tomorrow? It's more the comments that we don't know. That's the unknown component. So people are going to be listening for the tone, because it then creates expectations for market participants on what will happen the next Fed meeting, or what the CPI report may tell us for September, those types of things. Okay, so those are the key levels on the S&P and the probabilities on those levels. Let's take a look at the Qs, the NASDAQ 100 ETF. So also finding support over the last few days. So a lot of volatility still, particularly today. We see a wide range from the high and low, with basically intraday, just a fight between bulls and bears that ultimately ended up in a close near the open. So that tells us that, it basically paints the picture of what's occurring on a fundamental basis, is that market participants are waiting to see what the Fed says tomorrow. But again, the fear has already been priced in. over the past week or so. All right, so we are at a key support level, not on the close but today, but on the lows over the past few trading days, just like on the S&P. That's actually good news because it will help us navigate directional movement after the meeting's over tomorrow. So just like on the S&P, if this level holds and we close above, we expect a rotation higher. If this level breaks and we close below, we expect a rotation lower. 280 is a major level on the Qs for support. So we got two big levels, just like on the S&P, two big levels of support to keep an eye on tomorrow and the rest of the week. So this is our support zone on the Qs. And if we get a close below this zone, then we expect a retest of June and July lows like on the S&P. So tomorrow, if we see the market, we're going to see increased volatility. So again, just be cautious of that. But if we see the market rotate higher and close higher, then our expectation is that we're going to trade higher through the rest of the week. And so we want to also look at resistance. You know, where could we go from here? So this is our resistance zone on the Qs. So we have a decent amount of, points to pick up to the upside if we can rotate higher and these support levels can hold. So it could create buying opportunities. Yeah, Bruce, that is very interesting. Bruce said that 9/11 was known by some people because there was over 600% increase in put contract trading on airline stocks on September 7th and 10th. And of course, we'll never know if that was coincidental, related to something else that we didn't know about, or there was inside information that indicated a potential attack on the US, which probably, was the case. If you guys have ever watched Billions, the Showtime series, that's kind of all based around that.
Yeah, that was like the first couple episodes with it.
Yeah, that's how Bobby Axelrod got, made a bunch of money and got started in the hedge fund world by shorting airline stocks. But yeah, Craig said one of my favorite shows. Yeah, my wife and I watch it, but
I gotta catch back up, man. I think they're doing a new season, aren't they?
Are they? I don't know. We didn't start it till, I don't know, within the last year we started it, so long after it began, but we kind of hit a roadblock with it. It's hard for me to watch because being a hedge fund manager, it's like kind of makes it like you can't leave work, like when you're done with work, you want to go do something else. So it's like, oh, I'm back at work, even though it's obviously a show and over dramatized and all that. But
I gotta catch up, man. I've only seen like 2 seasons. I haven't been able to get back into it.
I mean, it's good. It's, it's kind of a lot of the same thing over and over, and it kind of turns into a soap opera, but it's not bad. Okay, so let's look at the VIX. And so we've been talking about this resistance level on the VIX for a couple of weeks now, at least a few weeks. And this is going to be key for tomorrow as well to help us determine directional movement after the Fed meeting and through the rest of the week. So this 28 level, make it more of a zone, but 28 is really the key level to watch for on the close for tomorrow on the VIX. So notice how since basically end of August, so end of August through September, 20th today. We've moved lower off this 28 level, but come back up into it. But we've been finding a lot of resistance here. And generally, when you see a lot of resistance like this, it's an indicator that a previous sell-off, which we have been in, and just looked at on the S&P and the NASDAQ, is losing steam and might reverse. So the VIX is giving us some clues here. But like anything else in trading and investing, there are no guarantees. So we still need to be prepared to react if the market tells us or gives us different information. So hopefully what you guys are noticing is when we're at major levels on the S&P and the NASDAQ, we tend to be at major levels on the VIX as well, which is why it's useful to use this as a combination tool for analyzing market reversals. So if 28 holds and we trade lower tomorrow off of this, which has the greater likelihood, we saw that in the option probabilities, the option math. We're seeing it on the charts, but we still need to see it after the fact, after the Fed meeting. And so if we rotate lower, and likely we will, because volatility spikes leading up to known unknowns, right? So we know there's a Fed meeting, when we know there's a rate hike coming, but there's still some unknown components that we talked about. Jerome Powell comments, his hawkishness, level of hawkishness. But once that all subsides, we're likely going to see volatility get reined back in. So most likely we'll see the VIX continue to hold the 28 level and move lower after tomorrow. But if it doesn't, and we close above 28, or particularly above 29, then mark my words, the S&P and the NASDAQ are going much lower. Again, back to June and July lows. So that's going to be your clue. You'll know ahead of 99% of other retail traders by the end of the day tomorrow. So just look at the VIX. What is it telling us? If there's still fear in the market, the VIX is going to go up. After an event like a Fed meeting tomorrow, if there's still fear and the VIX goes up, once the unknowns are hashed out and they're no longer unknowns and the VIX goes up, then the sell-off is gonna accelerate. If it doesn't, and we see the VIX hold this 28 by end of day tomorrow and close below with a red candle, and then also to add to that, we also see the support levels on the S&P and the NASDAQ hold, and price rotate higher off of those, then our probabilities are to the upside. If we want a directional edge, our bias is to the upside. So that's how we're going to handle what happens tomorrow and use that moving forward in the short term. Okay. Any questions, Richard, or comments, or?
Looks like Linda's just kind of curious to know, like, is it too late to say put on some sort of a hedge? Tomorrow when the market opens, or?
That is a great question. So one of the ways that we determine that is using implied volatility. So generally, when you're this close to an event, and so to answer that question for yourself, like moving forward, because I don't want to just tell you the answer and then have it come up again and have you not understand, how to determine that yourself, is that what I mentioned, that these types of events, and that's why it's important, I stress the importance of distinguishing between an unknown catalyst and a known catalyst. because for a hedge, if you're going to hedge a position or a portfolio, it should always be hedged because there's always the possibility of an unknown event. If you're going to hedge a known event, you want to do it far before the known event, because by the time you get up to the event, it's priced into the market. So the sell-off that we've seen, again, is priced in. So implied volatility is high. Let's look at implied volatility. All right, so the time to hedge would have been back in mid-August. So see how this is a graph of implied volatility. So this is forward-looking expectation of volatility in the market. So when it's low, we don't expect, or at least we expect a reversal back to the upside. So if you're going to hedge, you want to hedge when implied volatility is low. So that there were opportunities to do that back in March, right? We have low IV, markets at a top. What happened? The huge sell-off, right? We got back down to those levels mid-August. Markets been moving up. This is a good time to hedge. What happened right after? Huge sell-off. When IV is rising and high, it's too late to hedge, because once the known unknown is comes out and everybody's that's been holding their breath finally breathes out and takes a sigh of relief, you're going to see IV come back down. So you want to hedge when implied volatility is low, and this all ties into options strategies as well. And our topic for tonight, selling premium using straddles, you want to do that when IV is high, because it all goes against the crowd think, the group think, or the contrarian mindset of the markets. You don't want to follow with the crowd because most people are wrong. And it's, why Warren Buffett has one of the most famous sayings in investing is, be fearful when other people are greedy, and be greedy when other people are fearful. So be fearful down here when IV is low and the market's rising, and be greedy when IV is high and the market's falling, because then it reverses the other way. So another great tool to use, and also just overall, but in making trading decisions, whether you're going to buy or sell an option, or buy or sell a stock, or hedge a portfolio, is just to use implied volatility. So when you see implied volatility trending up and at relatively high levels, you actually, especially around an event that is going to pass by the end of the day tomorrow, it's too late to be fearful. The market's already priced that in from mid-August. But again, one piece of the puzzle. So it may make sense to hedge after the announcement tomorrow if IV comes down, but we close below one of these support levels, 3850, 3800. Because then you might see IV come down because volatility crush occurs after the announcement. You could see a subsequent rise in implied volatility and a continuation of the sell-off. So long answer to a great question by Linda, and a relevant one and an important one moving forward, not just for tomorrow, but you want to hedge when IV is low long before a major event. A lot of people do that with get caught in that trap with like individual companies around quarterly earnings announcements. They'll make options trades around, like buy a put or a call around a quarterly earnings announcement, and they end up way overpaying for the premium because the expected move or the fear behind the unknown, or known unknown, because we know that earnings announcement is coming out at a specific time on a specific day, but we don't know what the reaction is going to be, is then crushed when it comes out, and everyone's fear is, all of a sudden goes away, and we see IV come down. It's very analogous to like how we deal with fear and greed in everyday life, right? We tend to be more fearful of things we don't know, even if it doesn't really actually cause any severe damage after the event's over. So that's kind of what happens in the market. We have all this fear building up, but then it passes and you're like, it was anticlimactic. Like just happened the way we expected. Big deal. And then people start behaving normally again. That emotional aspect goes away, or at least subsides. So yeah, I think the best thing, like if you're not hedged at this point, putting on a hedge, for tomorrow doesn't make a lot of sense, because we're going to see probably some degree of volatility crush once the announcement is made there. Yeah, Keith. So Keith brought up a point that isn't outside of the realm of possibility and would create a major sell-off, is if they actually raise it more, like 100 basis points instead of 0.75, or 75 basis points, 0.75%. Then that scenario I went through where we close below the support levels in the major indices and we see the VIX spike up and close above that 28 to 29 resistance zone is going to come into play. So that's probably what is going to take for that circumstance to occur. I mean, it's possible that the tone of the meeting is going to be so hawkish that it could do that without a higher than expected rate rise, but probably not. And then conversely, Keith said if Fed increases by only 50 basis points, probably a moderate bear market rally. I would say if that happens, it would actually probably be a significant move up tomorrow and through the rest of the week. Probably more than moderate. Just because the expectation is so dialed in and strong around that 0.75 or 75 basis point rate hike. So any surprise on the number could also throw the markets in one direction. So if it's lower than expected, we're probably going to see a very big rise. But also, well, I don't want to speculate. I'm not going to say it. So yeah, if we see a less than expected rate hike, move up, greater than expected, move down, the move up will probably be less extreme than a move down on a greater than expected rate hike. So also consider those things, but really just watch the levels and what the market does around them. Because this will have a lasting effect probably through the end of September and likely beyond that until the next Fed meeting, and next CPI report, but certainly through the end of September. Whatever happens tomorrow is going to be a very strong clue for the rest of the month. So, be patient, see what happens. And then, that's when it really makes sense to make a move, pick a direction based on what happens tomorrow. And then, you can be committed to it because we've done our homework, we've done our analysis. So any other questions there, Richard?
No, I think we're good.
Okay, so tonight we're going to talk a little bit about option selling because, well, number one, it was a suggestion from last week as a topic, and one I was considering actually doing last week, but made more sense to cover some other things based on the market environment last Tuesday. But still a timely topic for this week because IV's high, and selling we want to be an option seller when implied volatility is high. It's been somewhat tricky to be an option seller in past years because the market's been on such a strong, we're in such a strong bull market, and IV has been relatively low for such a long time. But as we start to see these spikes in implied volatility, it can actually create opportunities for us as option sellers to collect more premium, do so in a manner that allows us to do it with more consistency and higher probabilities. And there's a lot of ways and strategies to do that in the options market. Actually, sorry, I got ahead of myself. Let me review the 36-month moving average. I just realized I skipped over that, and that's important. Sorry. Okay, so oops. Already on SPX, we want the simple. Okay, so real quick, and then we'll get into the straddles. In the 36-month moving average, so it doesn't, it's a long-term moving average on a monthly chart, so it doesn't react or change real dramatically week to week. So it hasn't really changed much from last week, where it resided right around 3,800. It's, if you look at the actual, get my tool up here, closing level from today, it's at 37.9912. So it's right around that 3,800 level, which was what our major support level. So there's a confluence between our 36-month moving average and our horizontal technical level that we looked at on the daily chart. So again, this is a monthly chart. We're looking at the 36-month moving average, and historically is a inflection point for rotations after a sell-off back to the upside. So also very important to watch for September, because we've traded down into it a couple months, rotated higher, then came back down into it. So this is going to be another critical month to monitor this moving average for directional indication. So looking at also at the NASDAQ, we're trading below. So although it held in August, we traded up off the level from the open this month, but then reversed lower. This is also going to be key, especially as we get into October and the rest of this year, to tell us give us an indication of likely direction through end of December, end of 2022. Because if we get a close below the 36-month moving average again, that's also going to be bearish. But if we can rotate higher, and the catalyst is there, after the Fed meeting wraps up tomorrow, and if those support levels hold on the daily charts, the VIX drops, and there's enough buying that comes in, it's not outside of the realm of possibility we could close back above it on the NASDAQ even. And then, again, very likely to see a significant rise in the markets through the rest of 2022, but almost certainly are going to have a negative year on the major indices. Getting back up to previous all-time highs on the major indices is very unlikely at this point. All right, so I just wanted to hit that because I almost missed it. All right, so going back, so a straddle involves selling well, it could be buying or selling, but we're going to look at short straddles this week. Selling premium, a put and a call on a individual equity or an ETF or an index. So some of the good ETF products that can be good tools for using the strategy would be like the SPY that tracks the S&P 500. We'll look at that one first, but the SPY or the Qs that we looked at to do our market overview analysis that tracks the NASDAQ 100 are good. The IWM that tracks the Russell 2000. And you can do these on like, sector ETFs like XLE that tracks energy. But these are good starting points for implementing the strategy if you're new to it, because it can be done on individual equities too, but tends to work better because individual equities can often, number one, they're exposed to more catalysts like quarterly earnings announcements, for instance, and you don't want to do some of these strategies around a quarterly earning announcement, more so with buying straddles and selling them, but it does incorporate more risk. So we can bypass some of that risk, mitigate it by using index products or ETFs that track indices like the SPY, the Qs, the IWM. And they tend to not make such extreme moves as it relates to a lot of equities that you might incorporate the strategy on. So we'll look at it starting out on the SPY, and I'll kind of give you some different rules of thumb or kind of a checklist, so to speak, of how to do this and why it can make sense. So we looked at implied volatility. We know it's moving up, right? In the context of a sell-off in the market, more fear involved, etc., leading up to the Fed meeting. So there's a couple things we look at in these types of market environments. And we've covered these in past meetings. So again, all of this knowledge is meant to build on itself. But before we get into that, just to explain what a straddle is, a short straddle. So we're selling a net seller of options. We are selling an out of the money put. So we're selecting a strike price below the current price of the asset, and we're selling an out of the money call, a strike price above the current price of the asset. And our goal is, and we'll break it down as far as how to manage it, is for the underlying to not trade past either of those prices. And you'll see here shortly that on the indices, and in this case, the index ETFs like the SPY, you can actually sell very far out of the money and still collect some decent premium with a very high probability of success. But just like any other strategy, whether it's options-based or equities-based or futures or whatever, the strategy is actually a relatively small component of the success equation. It's the management of the trade that leads to long-term success. And we don't care what one particular trade does unless we're over leveraged. If you ever find yourself concerned or caring or fretting about a losing trade, then you over leverage yourself. That's all it is, because of course you're going to have a losing trade. So if that ever becomes an issue for you, then you're trading too big. Trade much smaller. So the same rule applies here. We trade these very small because over time these relatively small wins add up to a lot because we have a high probability of success. And the way we manage these builds on that. It contributes to that success. So as an analogy real quick, if you guys are familiar with iron condors, so it's selling an out of the money put credit spread and an out of the money call credit spread. Somewhat similar to the straddle strategy we're going to look at, but without the long options involved. If you look at the math on an iron condor, it's actually a losing strategy. So if you sell 20 delta, put in call spreads and set up an iron condor and just put the trade on and leave it to expiration, it has at a 20 delta about a 67% chance of success, but in the 33% chance of the failures, it wipes out the winning trade. So it has kind of a round or a zero expectancy or even a negative expectancy if you just do the trade. So in order for that strategy and most strategies to be profitable, it's not really about the strategy. It's about how you manage it. When do you take profits? When do you adjust it? How are you managing it after you put the trade on? Because you can there's a lot of great strategies out there that people lose money with. And there's a lot of bad strategies that you can actually, believe it or not, make money with if you manage them after and that's a core methodology at Altos. Is we're not really so concerned about the trade initiation or the strategy itself as we are with the management of it as the trade progresses. So it's that management that really creates a positive expectancy so you can make money over the long run. So no different here. So and we may need to carry it over to next week because this topic, so we'll at least get started on it, maybe get into more of the management of it next week, but we'll at least kind of get started on that part of it because the setups is pretty easy. Again, it just involves selling a put and selling a call out of the money. So I'm going to give you some of the rules. Number one, backing up to as we kind of start to do our planning for this type of trade, we want to look at number one, the VIX. So this selling a straddle can be effective during high IV environments, not too high, but also not low. So when the VIX is like in the, so that's the first thing we want to look at. When the VIX is, in the 20 to, let's just say 29 range, this can be a good strategy. Maybe higher even up to 35. If we start to see VIX really taken off above 35 or 40, then I'd stay away from this because the volatility is far too high. Or if you have an open position, get out of it. When the VIX is too low, 19, it's still okay. But if the VIX is like down at 9, 10, 11, remember, it's inevitably going to spike up, which is going to cause more volatility in the market in bigger directional moves. That can harm a strategy like a straddle or an iron condor, or so pretty much any option strategy that's not in line with your directional expectation or the timing of implied volatility. So we're in the sweet spot right now, really, for a straddle. So that's the first thing we look at is that where's volatility, but we also want to look at volatility on the asset that we're trading. Oops, let me get back over to the SPY. All right, so we're going to look at expected move, and we're going to look at deltas and the general volatility of the asset. So the next step before we do that is expiration. So if we want to set up a straddle, what expiration do we choose? And we can choose multiple expirations. These are trades that we can leg into or set up at different intervals in time, even on the same asset. Like I might set up a straddle on the SPY this week. Then based on where it moves by next week, I might set up another one. So you can spread these out in terms of capital allocation, diversification through expirations, but also through different assets, different symbols, etc. For index products like or ETFs that track them, like the SPY or the Qs, we want to go out, fairly far in expiration on these, because we're going to be selling very low deltas. So at bare minimum, 30 days, but even closer to like 35, 40 days. We could go out further, but when we consider other, market fundamentals, geopolitical risks, and where we are right now, and out, just leaving a secular bull market, entering bear market territory, I don't want to go out too far because there's too many unknowns. So remember, the further you go out in expiration, the more can happen, right? So kind of between 30 and 40 is my sweet spot. So maybe I'll look at the October 28th expiration. That's those contracts expire 38 days from now. Okay, so that's kind of the rationale behind selecting an expiration. We obviously want to do this with very liquid options. So look at open interest. In volume, so we want to, there's SPY is very liquid. That's why I suggest these symbols, SPY, Qs, IWM, they're very, very liquid. No issues getting in or out of these, even close to expiration. But our intention isn't to hold these until expiration. So the cool thing about these is they're easy to manage, and we can keep doing these over and over as the market moves and adapt to the market and book profits along the way. So the next consideration is our strike selection. All right, so we've got our expiration, right? About 30 to 40, maybe even up to 50 days out, just kind of depending on what's happening in the markets, in the world, and the economies. So we're selecting the October 28th, 38 days out. Now we're going to start looking at strikes. So when we sell a put and we sell a call, we're going to collect premium on both legs of that trade, right? So my rule of thumb is on the put side. So if you look at options chains, put premium tends to be juicier, which is a term I just use for like higher. You're going to collect more premium on the put side than the call side generally. That's because puts are used as insurance, and there's more demand for them due to the fear of a sell-off in the market. So they tend to be priced more expensive. So we're going to want to look at delta. So you'll want to make sure to add delta to your option chain, and that's how we're going to select our strike. We can use other methods in addition to the delta, like the support levels, and we're actually going to use one in particular, the expected move. And the more of these things you do as part of the planning process to build your trade, over the long term, the better you're going to do it, I believe, and I've found in my own trading. So when you can find these, major levels of support and resistance below and above your strikes, that's even better, and particularly outside of the expected move. So between today, September 20th, and October 28th, the markets are expecting a move up or down at 26.98 points on the SPY. So that's number one, very good information to have in helping us select our strikes. But a short straddle, when we're selling a straddle, or actually even buying a straddle, is more of a market neutral approach. The market can go up or down, or it could stay flat. So that's kind of the beauty in this strategy, is that we don't have to necessarily be right on direction. We just need to be right on probabilities and then manage it appropriately. So that's the great thing, is there's no guesswork here. We know what the probabilities are. And so we're going to use those to our advantage. So for the strike selection on the put side, I like to look right around a 10 delta. So again, here's our delta. So we're just looking, puts have a negative delta. When you end up selling a put, then you have positive deltas. We won't get it real deep into the Greeks on our session tonight, but calls have a positive delta. So when you sell a call, then the position is negative delta. But basically what the delta tells us a lot of things, but mainly it's the move in the option, the pricing of the option, the premium here that we see in the bid-ask spread based on a $1 move in the underlying security. So if the SPY moves $1 up or down, the 340 strike options are going to move 10 cents. That's not static, unfortunately. That's where the other options, Greeks and stuff come into play. But topic for another day. We don't need to really be concerned about that for the strategy at this time. So we're looking for a 10 delta. That's a pretty low delta. The other way delta is used is it tells us a rough probability that that strike will expire out of the money. In other words, the SPY will close above the price, the strike price, 340. So the options market, the way that you do that is just subtract it from 1. So it's 0.9. Again, just ignore the negative. And then convert that to a percentage, so 90%. So this delta is telling us that there's a 90% chance that the SPY will close above 340 by October 28th. So if you ever want to know, like, whether you're trading a stock or, I mean, really valuable information, particularly with this strategy. So we have a very high chance of success, 90%. And truly, when we combine it with expected move and support and resistance levels, the edge that we get increases beyond the option probability. So we could more realistically have like a 95% chance of success if we just put this trade on and did nothing. I'm not even talking about managing it. We just put this trade on and did nothing. 95% of the time, we're going to collect 100% of the premium. All right. So then for the call side, I like to sell right around the same or slightly higher delta. So we could look at, clear this out here. So like a 10 to 12 delta. So the 418 strike it's trading at a 12 delta. All right, so let's look at the chart real quick. So we're looking at a 418 call and a 340 put. All right, so it helps to mark these on your chart. And we'll talk about using the Bollinger Bands here too, in addition to the expected move. It's another little edge you can get with this strategy. So there's our level on the call side. What did I say, 350 put?
340.
340. All right, so this is our profit zone on the short straddle. So as long as the SPY closes within this range in the next 38 days, the trade's successful. You keep 100% of the premium collected. That's a huge range, right? So that's why it has such a high probability of success. It's very unlikely we're going to close past these levels. And particularly if we incorporate these levels with other technical analysis like the horizontal support and resistance, but also notice what's happening here. Our 2 standard deviation upper Bollinger Band is just below that level and it's moving down. So that's going to be even added protection to the upside. Our lower levels way out, it's far below mid-June lows. The odds of hitting this, we're more likely to encounter an issue with the upper, but it's still very unlikely because we have horizontal resistance, and as this upper Bollinger Band moves down, it's sloping down, downward very steeply, will be below the call strike, right? 418. So we've got really good technical protection, and we're trading somewhat in the middle of this zone, maybe slightly biased to the upside. So that might again be our bigger risk to encounter, but we're going to manage the trade as we go. We're not necessarily going to hold this till expiration. So one of the many advantages of the short straddle is time decay is working for us. So even if the SPY, just stalls and doesn't move a lot all of a sudden, if implied volatility drops, like it almost certainly will after the Fed meeting wraps up tomorrow, as time moves on, after we put the trade on, all these things work in our advantage as on the short straddle strategy. They're all going to add money to, profit to the trade. So that's how we select our strikes on the put and call side. So basically, you can do these individually, but most platforms will have an option just to sell. So you can click on one of your strikes, either on the put or the call side. And we're going to be selling a straddle. Okay. So just to give you an idea of so we selected the 340 puts and the 418 calls. All right. So you'll want to obviously adjust the contract size to, to match your risk tolerance. But these theoretically have unlimited risk on both. You can't lose both sides of the trade because the market can't close past both strikes at expiration. So even if you did nothing, you're guaranteed to win one side of it, but you don't want to lose the other side badly. So that's where the management component comes in. But if we put this trade on at the midpoint, which is one contract on, happened here. So we want to be 418 call and 340 puts. Oh, I might have selected a straddle instead of a strangle. Let me redo that. So a strangle is when you're selling the same strike.
I think it's a straddle.
Yeah, what did I say?
Well, this is a straddle right here. Are you trying to pick a strangle?
Yep. Dang it. Yeah, sorry. Straddle's when you do the same strike. Strangle is when your strikes are different, but same expiration. Sorry, hopefully I didn't confuse anybody there. So 340, 418 is our call and 340 is our put. All right, so at the mid, if we put this on with one contract, we would collect $343 in premium. Okay, so again, you want to do this obviously based on your position size and should match your risk tolerance, your account size, etc. And it definitely helps, and we can cover this next week because we'll follow up on this topic next week as well, and get more into the management component. We'll start a little bit on it today, but you'll want to look at the option probability. So we'll spend some time on that next week to get an idea of your risk. Like if the market does move towards one of your short strikes or even surpasses it, we want to know what our risk that's involved based on our contract sizes. So you collect the premium when you sell a short straddle. The premium is deposited in your account. Now, if you held it till expiration and the underlying asset doesn't close past either your short call or your short put strike price, then you keep the entire premium. But unless the market, we need to be adaptive with these strategies. And, unless the market's really trading flat, we're probably not going to hold it through expiration. We're going to manage it, and maybe even set up more straddles. Sorry, strangles. Keep using the wrong one. No, geez, end of the day. Strangles, sorry. So if the market's flat, then we can leave it on longer, closer to expiration, or even through expiration. If we're getting strong directional move towards a strike, we want to manage the side that's profitable. So like in the case of the SPY, if we set one of these up and then the SPY moves up, remember our short call strike's way up here, but let's say it starts moving up, into like the 400, 405 level. Well, our short put that was way down here at 340 is going to make money and be trading at probably pennies at that point. So we can actually just close out of that and sell it. And that's where the management part comes in. We can even sell a higher strike put, bring in more premium within the same expiration cycle, and use that premium to then hedge our call. But we might not want to do that right away. We might want to wait to see if it really gets threatened. And that's, again, building on what we've learned in past weekly sessions, where we want to be looking at deltas and probability of touching and probability of expiring out of the money, how close to expiration are we. So there's a number of things to consider in the trade management part, which is why we'll carry it over to next week. It'll take some time to go through that. But ties into some of the other option strategy topics we've looked at. If we sell on both sides of the market, like with a strangle, and we close out a profitable side, we can take the collected premium from that, particularly if we roll it and open that strike at the same expiration, roll the strike price up, collect more premium. We can take that credit collected to buy a hedge if it's needed on the call side. So there's lots of cool things we can do to manage this trade and make adjustments to it. In addition to, scenarios, a lot of times we have such a wide zone here of profitability. The vast majority of the time, and as we looked at in the statistics, 90% of the time, and probably greater again when we're using Bollinger Bands and horizontal support and resistance, probably closer to 95% of the time, we'll be successful without doing anything. But rule of thumb. So if you'll notice when I set that trade up, you'll see the premium for both sides of it.
Yeah, I was going to say that there's a couple questions around that structure.
Yeah. So I was going to go back to that because this comes into the profit taking and management part of it that we'll get into deeper next week. So selling the 340 strike at the midpoint, let's just see what it is, because we can just brings in about $190, right? So particularly if the underline's making a strong directional move, not so much if it's flat, because then we'll see a lot more theta decay and we'll see the open profit on that position rise more quickly. But regardless really of what happens, we want to start looking at profit taking at 50% of the premium collected. So the strategy, when it's executed the way with the rules that I've given you, is so consistent. You don't have to bank the whole profit on the credit for it to have a positive expectancy over the long run. So if we collected $190 per contract on the put side, then we want to look at taking profits at about 50% of that credit, like 18, 19, roughly.
A couple of questions that came in is, is this considered like a naked trade, or do like both sides secure each other? And what's kind of the margin to say put one on from a
Yeah,
second?
so that's something you'll want to look at when you build the trade and put it into your broker platform, and before you hit send, before you actually route the order to your broker. Reason being is it is a margin trade. So you have a naked put and a naked call, but it's not the same as only selling a naked call and only selling a naked put, because obviously it's market neutral. So you do have some degree of protection on directional moves from the other side leg of the trade, either the put or the call side, depending on which way the market goes. But it is going to still require a higher degree of margin, but it's going to be based on your position size, how many contracts you're trading, how your brokerage account is set up, whether you have portfolio margin or a standard reg margin account. There's other variables. So I can't give you an exact answer. So the best thing to do is to check with your broker, look at the margin requirements before you enter or route the trade. So after you enter it, before you hit click and send and route the trade to get filled. And you can get an idea of kind of what the margin requirements are based on your individual circumstances in your account, because they won't be the exact same for everybody. But that's important information to use for position sizing, etc. But also, and we'll get into this next week because it takes a bit more time. We'll look at the probability, the risk graphs, so the actual options graph, and look at different scenarios. If the asset did rise or fall towards one of your short strikes, what is your potential loss at any particular point between when you enter the trade and the expiration date? Is going to really help you gauge the risk events. If they happen, then you need to be prepared for them and manage them. So if we get a directional move, either up or down, so if we go up, then it's going to benefit our put side. So this premium is going to drop, which is what we want to have happen as an option seller. We're going to want to start looking at closing this side of the trade out, the put side, on a rise in the asset at about half the premium we collected. And then same thing with the call side. If the asset drops in price, the call side is going to be the side that's making money, and we want to close that at half of the premium collected. So this is the first step of the management process, and there's a couple more we'll do next week. But at the 418 strike, we're about 150 to 153 bucks per contract. So when we're at about $75 of open profit on one contract, we want to look at taking profits and then managing the trade from there, making adjustments, potentially rolling strikes, opening new strikes at different expirations, or maybe the same. Again, we'll get into that next week. But that's the first step. Once we hit a 50% profit on either leg, we want to look to take profits or get out. And that could happen on both legs. If the market doesn't move enough, and particularly around a high IV implied volatility environment like we're in now, leading up to a Fed meeting, purely, regardless of which direction the market goes, we can see volatility crush. So that's basically when implied volatility has been rising, like it was, and we looked at on the chart of the S&P, and then it suddenly drops because a fear around an upcoming known event has already passed. Even if an adverse move occurs or no move occurs, we can see the position profit, because IV drops, and that causes the premium in the options to drop as well. So it can benefit from a lot of different outcomes. So even if IV drops on both sides, if we've got a decay of 50% of the premium on the put and the call side, then we can just close the whole strangle trade. Again, we'll get into more detail on that next week. And then also the last thing real quick is the expected move. So I mentioned that we want to look at that. And if your options platform doesn't provide expected move, Thinkorswim does here at each expiration. You can look over to the right from the expiration. And this plus or minus is going to give us the expected move, 26.99. So we can look at the current price from the day we put the trade on, which is at 384.09, and add and subtract that from that price. right? So if we subtract, let's just say 27 to make it simple, from 384, I'm not even going to try to do math right now because my brain's fried from trading and doing this stuff all day. But this is where I'd pull my calculator out. But subtract 27 from 384.09 or even 384, and if our put strike is far below that, which it should be if you're selecting a 10 delta, then we're outside the expected move. Same thing on the call side. We add 27 because remember the expected move is plus or minus. We don't know which direction. And yes, we can exceed the expected move, but a high percentage of the time we stay with an expected move. And it's when we go out of it that we're going to really need to look at management component of this type of trade. We add 27 to 384, right? And our 418 strike is above that expected move. So on the put and call side, the strike prices that we're selling our puts and our calls are outside the expected move. They're outside of significant support and resistance levels. They're outside of the outer Bollinger Bands. They're at the deltas that meet our criteria. So see how all these things are, coming in together to give us a big edge. But that's just the structuring part of the trade, building the trade. That's the edge in building it. We can get even more edge by managing it. So I gave you the first, step in managing it, which is closing at a 50% profit. So in other words, because we're option sellers, we want the price of the options to go down, and that can happen with drops in implied volatility, with the market trading flat, with time going on between now and October 28th, because that's called theta decay. So even when you buy an option, you're actually paying to own that option every single day, and you can know exactly what that amount is by looking at the theta, which is another options Greek. It works the opposite when you're an option seller. You're actually getting paid to own to be a seller of that option every day, regardless of what the underlying asset does. If it doesn't move a penny in price, if it moves against you, you're actually getting paid to take that short position on the option. And that's your theta. So the theta will tell you in an exact number every single day what you are getting paid as an option seller to be that seller of that option. And we'll look at that next week too. So as time goes on, it can benefit the position. As an IV drops, it can benefit the position. As the markets stay within the strike range and we get closer to expiration, it can benefit the position. So there's a lot of ways that it can benefit this position in this type of strategy. And the idea is, and seldom would we ever hold this up until expiration. So we want to close it at a 50% profit. So again, that's when the premium that you collected at the strikes is trading at half of what you sold it at. So half of about 190. And I think on the call side at the 418 strike, it was about 150, about half of 150. Then book the profits on that. And then we can restructure it based on where the market's trading at that time. So it's kind of a revolving wheel of entry and management. So we're just kind of moving along with the market, just doing what the market tells us. So those are the rules for setup and the first step of managing it. And we'll get a little bit deeper into management in different circumstances and looking at risk graphs and things like that, and probably do some look at other tickers besides just the SPY. So I gave you some that can be good starting points to practice this on in the meantime. So yeah, Rob, good question. Rob asked, wouldn't closing out one side leave you naked? So when we do close out one side, we would either roll or re-enter at the same strike in a different expiration. So roll up or down and strike, and either at same expiration or out, so that we still have the strangle on. But a lot of the time you'll be closing both legs right around the same time or at the same time, because they're so far out of the money, they're going to decay very quickly. And that's why we don't actually hold them till expiration. Even though we're selecting an expiration cycle in this example, 38 days out, we're not going to hold this trade for 38 days. We could see that decay happen by even Friday this week. I mean, this is not a guarantee or even a speculation. It's just, it can happen. So it can happen rather quickly within the expiration cycle. So we may be turning these over, and actually almost certainly we'll be turning them over far more quickly than the expiration cycle that we select. The expiration cycle is just allowing us to collect an adequate amount of premium for the risk and giving us time to make adjustments. That's really all it's doing. A few other things like gamma risk and things, but for the most part, those are the major things. So we're not going to be holding it that far out generally. All right, guys. So we'll follow up on this next week, certainly, because there's more to get into on the management side, and we'll recap the rules and stuff for building the trade as well next Tuesday. But any questions on that, Richard?
Here's a last quick kind of question: if you thought what the advantage was of a strangle over an iron condor was?
So great question, and there's a number of them. They're easier to adjust. So anytime you have a spread where you involve multiple legs on the same side of the options chain, so like a call spread or a put spread, which of course an iron condor uses both a put credit spread and a call credit spread. But it's that long option that creates more challenges and difficulty for adjusting the trade. So trade adjustments are easier with purely short options. And I'll mention one other thing too before we sign off. It's important, and we'll cover next week. So that's one thing. You, on a contract for contract basis, collect more premium because you're not having to buy a long option. So those are kind of the two main ones. But what we're also going to look at next week, and it's part of the trade management process, is actually converting these into, I think I did mention it actually briefly, is converting these into a spread. So we can actually buy hedges within these. So while you might put it on as a short strangle, maybe based on what happens between entering the trade and within our expiration cycle, like if we get a strong directional move and we book profits on one side of the spread, let's say the market moves down and we book profits on the call spread and we need to make adjustments to the put spread, we may sell another call spread at a lower strike and then use some of that premium to buy a hedge. So it could, as part of the trade management process that we'll cover in more depth next week, we could end up converting one of the short legs on either side based on what happens to the underlying to a vertical spread. And then we can manage that, if the directional move occurs, because remember, we've strategically selected these short strikes that are very likely to hold by expiration. It creates more profit opportunities because we can make money on the hedge, close it out, and do more things with that. So if you guys are familiar with the wheel strategy, it's often called, or it's basically selling puts, getting assigned shares, and buying or selling calls against the shares, getting called out, and then reselling puts. It's a good way to look at it as that process. It's a trade that you can really have on all the time and just be managing and adjusting. And so there's different legs of it that we can incorporate too. We'll do that more next week. So good question. But yeah, the main advantage is, it's easier to make adjustments to, and you don't have the long leg that reduces the premium or the credit that you receive on a contract per contract basis.
All right.
By the way, there's a lot of hedge funds that use strangles like this. This is definitely a hedge fund strategy. A lot of hedge funds sell 10 delta strangles. But and as a part of the management, and as we look at the risk graphs, we'll talk capital allocation, because that is crucial. Because obviously hedge funds if you have a big fund that has hundreds of millions or billions of dollars, they have, the margin and risk is less of a limitation as it might be if you have a smaller account. These can still be done, in a personal account, but risk consideration is crucial. Like, you don't want to over leverage based on your account size. So we'll talk more about contract size, position sizing, and look at the risk graph so you have a feel of what the max risk is. But the idea with this strategy, and really we don't want to get to the max risk. We want to manage this so that that's not the issue. But we're still always prepared for the worst. But we want to, we don't want to hold these until all the way through expiration, unless there's the underlying assets really just trading dead center between the strikes along the way, which can happen. And there may be circumstances where you hold till expiration, but most of the time not. You're just going to take the credit. So we'll look at all these different circumstances and variables next week, because we definitely ran over, and appreciate all your patience, guys, and sticking with us. It was a bit of a long session tonight. We didn't get to ticker roundtable, but hopefully you like the strategy. You'll practice it, and certainly do practice it before ever putting any of your own risk capital in the market, so you get a feel for it, and don't just jump in and do it because it sounded good. So there's a lot of things to consider, and we'll continue on with that next week. So any final questions to wrap up?
No, we're good. Everyone says just thanks for all the teaching on this strategy. I think a lot of the folks are very intrigued by it, and obviously you guys can watch the replay if you missed any part of it or want to hear it again. I think it'll definitely sound better the second time around too.
Yeah, we'll get the replay up tomorrow, and hopefully you guys can join us next week. If not, we'll record that one and also post it. But thanks again, everybody. Have a great rest of the week. Keep an eye on those levels for tomorrow after the Fed announcement, and where we close. It's going to give you a really strong indication of directional movement through the rest of this week and even through the end of September. And we will see you guys all next week.